Is the American dream of homeownership about to become a financial nightmare? Nightmares are dreams too. I've got some startling or at least interesting news that every homeowner and future homeowner needs to hear. We've just hit a record-breaking 35.1 trillion in total US homeowner equity in Q2 2024. That's an eye-popping 85% increase since Q2 2019, fueled largely by the pandemic housing boom. We all know about this. Ultra low interest rates, of course, we know about that. Government stimulus, of course, we all know about that. And the remote work revolution sent housing demand through the roof. Sounds like a cause for celebration, right? Tons of equity, everybody's happy. But hold on, because beneath the surface lies a looming threat that could shake the very foundation of our economy. Active housing inventory is on the rise, and not just by a little. States like Tennessee, Texas, Idaho, Florida, Colorado, Utah, Arizona, and Washington have surged back to pre-pandemic inventory levels. Some metro areas are even surpassing these levels, with the Sun Belt and Mountain West leading the pack. We're talking about a 34% increase in national active listings between September 2023 and September 2024. Buyers are gaining leverage, homes are sitting on the market longer, and months of supply are creeping up. Is this seasonality or is this crisis? Remember, when inventory floods the market and demand wanes, prices don't just stabilize, they can plummet. The last time we saw trends like this, the housing market didn't just cool off, it absolutely crashed. Homeowners watched helplessly as their equity evaporated overnight. Is it historically about to repeat itself? Consider this. Many homeowners are locked into these tantalizing rates, incredibly low rates of 2 and 3% mortgage rates from the pandemic era, making them reluctant to sell. But with new listings suppressed and active inventory rising, something's got to give. Builders are offering affordability adjustments, attracting buyers away from the resale market. And let's not forget about the external shocks, like spiking insurance premiums and the aftermath of the most recent natural disaster and ones to come. They are hitting markets like Florida hard, North Carolina hard. So have we reached the peak of this housing wealth mountain? Is the crash already in motion while most are still admiring the view from the top? Today, I'm going to go ahead and dive a little bit deeper into some of the details, connecting the dots between the soaring equity and rising inventories. And what I'm uncovering is both alarming and frankly undeniable. The signs are all around us. Increased active listings, market shifting power to the buyers, and a national softening that could signal the end of the boom and the start of the bust. You need to know what's coming to protect your investment and make informed decisions. So stay with me. Trust me, you're not going to be able to afford to miss out on this one. Let's unpack this a little bit. Why does this mountain of home equity matter so much? Because for most Americans, their home isn't just where they live. It's their biggest financial asset. We all know this. We hear this on a regular basis. When home values soar, homeowners feel wealthier. And that's called the housing wealth effect. It kicks into high gear when that equity is skyrocketing. People start spending money more freely on renovation, new cars, vacations, you name it, they're spending it on it. In fact, studies show that the changes in home equity influence consumer spending more than the fluctuations in the stock market. So let that sink in for a second. An illiquid asset, it changes the behavior of consumers rather than a more liquid asset. Doesn't make a whole lot of sense. Now, the reverse is true. When home equity starts to slip, it's not just a number on a balance sheet. It hits Main Street hard. Negative equity or declining home values can put brakes on the consumer spending faster than you can say recession. Local economies start to feel the strain as wallets close up. Take a look at places like Austin, New Orleans, Punta Gorda. These places are already experiencing the fallout. With home prices dipping, consumer spending is tightening. It's coming to a gridlock. It's a domino effect that can lead to job losses and a slowdown in economic growth. We've been riding high on this equity boom for quite some time, but what happens when the ride stops? Are you prepared for the ripple effects that a downturn in home equity could unleash on our economy? Now, how did we get to this precarious peak? The pandemic housing boom didn't happen by accident. It was a perfect storm of factors. Ultra low interest rates, thanks to the aggressive moves by the Federal Reserves, made borrowing cheaper than ever. Government stimulus checks put extra cash in people's pockets, and the remote work revolution untethered the workers from the expensive urban centers, fueling a migration to more affordable areas. Demand for housing surged like never before. If you're a homeowner, you've all experienced it. But here's the kicker. The supply side couldn't keep up. New construction would have had to increase by 300% to meet the unexpected demand spike. Not exactly feasible. As a result, we saw prices overheat, and with Case-Shiller National Home Price Index reporting a staggering 59.5% increase from June 2019 to June 2024, many homeowners locked into these rock bottom 2% and 3% mortgage rates from the pandemic. These low rates didn't just make houses more affordable, they accelerated the equity growth because a larger portion of each payment went towards principal rather than interest. Essentially, people were building wealth at a faster clip without even really having to try. Just simply by making their monthly payment, they were building more equity than they ever have before. Now, with so much equity on the table, homeowners are eyeing home equity loans and second mortgages like kids in a candy store. And lenders, of course, they're more than ready to oblige. Industry insiders believe that tapping into this equity could inject a much-needed liquidity into the economy, potentially averting a deeper recession. If homeowners start borrowing against their homes to spend on renovations, education, and other big-ticket items, it could give consumers spending the shot in the arm it desperately needs. But let's not kid ourselves. This is a double-edged sword. We all know this. On one hand, increased access to equity could stimulate the economic growth and provide individual with the funds for, important life expenses. On the other hand, it opens the door to over-leveraging and increased financial vulnerability. Remember the housing crash of 2008? Overextension was a key player in that catastrophe. So could home equity loans be the pressure release valve that saves the U.S. from an economic downturn? Or are they the fuse leading to another financial explosion? The answer isn't black and white. We all know this. But one thing is for sure. The decision we make now will have long-lasting impacts on both your personal finances and the broader economy. All right, let's dissect the shifting tides in the housing inventory and what it means for you. Let's turn our attention to the front lines of the unfolding scenario, the local metro areas where cracks are already starting to show. Markets like Austin, Dallas, Tampa, and parts of the Mountain West are experiencing surges in housing supply. Active listings have absolutely skyrocketed, and in some cases surpassing pre-pandemic levels. This isn't just a statistical blip, it's a flashing red warning sign. Now, that being said, there's a lot of question about seasonality. We've seen this on a regular basis year after year. This time of year, we typically see a significant increase in supply. Now, when supply floods the market, sellers lose their grip on their pricing power. Homes sit on the market longer, price cuts become more frequent, and buyers gain the upper hand. This shift puts downward pressure on home prices, which can erode that precious equity homeowners have been banking on. Now, remember the housing wealth effect we talked about earlier? Well, it cuts both ways. As homeowners watch their equity shrink, their willingness and ability to spend diminishes. This doesn't just affect individual checkbooks, it ripples through local economies, leading to reduced consumer spending, slower business growth, and potential job losses. It absolutely can be a leading indicator if we watch the supply increase and the values come down. Take Austin, for example. Once the poster child for rapid growth and soaring home prices, it's now seeing inventory levels climb and prices are starting to soften. Sellers are feeling the squeeze and buyers are negotiating harder deals. The same patterns are emerging in places like New Orleans, sections of the Florida Gulf Coast. If you think this is contained to a few isolated markets, think again. These trends have a nasty habit of spreading, especially when fueled by shifting buyer psychology and economic headwinds. Buyer psychology? Well, let me explain. There's a new twist that's adding fuel to this fire. A growing number of potential buyers are adopting a deflationary type of mindset, holding off on purchasing because they believe interest rates will drop in the near future. I don't necessarily disagree with them, but they've all heard the chatter, seen the headlines, and now they're trying to time the market to snag that elusive lowest possible rate. So with interest rates continuing to drop, will that put additional pressure back onto the selling side? Time will tell. The irony of the entire situation is this collective hesitation to time the market or time the interest rate market can actually contribute to the very market softening they're betting on. As more buyers sit on the sidelines, demand decreases, inventories build up even further, and prices face additional downward pressure. It's a self-fulfilling prophecy that can accelerate market declines. This wait-and-see approach isn't just affecting buyers, it's putting additional strain on sellers and the broader economy. Homeowners who need to sell, whether due to relocation, financial hardship, or just life events, find themselves in a tougher spot. They're competing in a crowded market with more listings and fewer active buyers. The longer their homes sit unsold, the more likely they are to reduce prices, which could then lead to further equity erosion, which could then possibly lead to missed payments and then into foreclosure, and then the whole thing falls apart. Now, let's not overlook the impact on new construction. Home builders facing increased inventories and cautious buyers may pull back on new projects. This slowdown can lead to job losses in construction and related industries, adding another layer of economic strain to the local markets. So, where does this leave this? We're standing once again at a critical juncture. The combination of surging inventories in key metro areas, the psychological shift among buyers waiting for lower rates, and the potential for widespread equity loss is creating a precarious situation. If the housing wealth effect reverses on a large scale, the consequences could be severe, not just for homeowners, but the entire economy. Is this the tipping point where housing market moves from a slow leak to a full-on burst? It's a question you can't afford to ignore. The data is telling a story not of panic, but of caution. It is not of outright alarm. You just need to be actively paying attention. Active listings are up, buyer demand is shifting, and economic vulnerabilities are becoming more pronounced. In this environment, information, once again, is power. It's key to your success. Whether you're a homeowner, a potential homeowner, or just concerned about the economic landscape, staying informed is crucial. Don't get caught off guard by the changing tides. Understand the dynamics at play so you can make a decision that protects your interests, your family's interests. Folks, we're in uncharted territory. This is not very similar to 2008. The signs are all around us, and the time to pay attention is now. Do me a favor, subscribe, comment below. Let's start and continue a discussion about what your thoughts are. I'm happy to listen, happy to comment back. That's another guaranteed video. We'll see you on the next one. Do not ignore these warning signs. It is not an option. Stay tuned, stay informed, and let's face these challenges head on together. Take care.